We have a very divergent economy in Canada right now, where we do see some ongoing weakness in the energy markets, and that's impacting Alberta, Saskatchewan. We're seeing some benefits in other provinces, particularly in BC, where we do expect to see growth around 3.5%, which will lead the country this year, and largely driven by that low Canadian dollar pushing up tourism, other manufacturing. Housing markets still have remained pretty strong going into 2017, but there is some weakness there. Ongoing basis, the low oil prices for Canada as a whole, that will continue to impede the capital investment cycle. Exports are not as strong as expected. And the other issue, I think, is that low commodity prices as a whole will still impede overall demand in the market for capital investment. When we look at the housing market, which has generally been a key driver for the economy alongside consumption, the new mortgage insurance rules is going to hamper that area of the market, and we could see some drop-offs in sales as well as housing starts and prices over the next 2 years. Housing demand as a whole is going to slow considerably in terms of sales side. So that would also mean that pre-sales for construction are likely going to be a little softer going forward. For the construction industry, and that will mean slower than anticipated housing starts, and maybe they had probably previously expected in their planning. I think there's very divergent economic conditions. I think the larger urban areas across Canada, and particularly in Vancouver, are doing very well. They're benefiting from a lot of the key growth drivers. The areas that aren't doing well are some of the smaller urban and rural areas, which are more geared towards commodity prices, but also interprovincial labor from people who are working in the Alberta oil sands but living in other regions of Canada. Areas that are doing well, the industry is doing well, is largely on the retail side. Some of the transportation side is doing okay. Public administration is also a driver. So again, where the weakness is the commodity-oriented sector. So if you're a construction group, you're really looking at, I think, still high levels of residential investment activity as a key driver, and possibly one or two major projects in the province, but again being held back by that commodity picture. Given the fact that LNG prices are so low, even LNG projects are going to find it very difficult to find an economical reason to start up in the next few years. That's probably going to be pushed back into the mid-20s at earliest, at least on a large project basis. We do expect to see other drivers, though, in the market. I think that the population growth that we're seeing in BC that's flowing not only into Vancouver, but also areas like Kelowna and Vancouver Island should provide an uplift, again, for the consumer sectors and other types of, and at least provide support, again, for the residential sector and the economy. So overall, I think residential will still outperform relatively in the market. Well, I think for Canada, what we're looking at is the impact of global growth as well as on our interest rates. So right now, the global growth profile seems to be quite weak. There's a lot of uncertainties in the market right now, and that's really holding back interest rates. If there were to be a substantial uplift in economic growth, for example, we see increasing interest rate profiles. That being said, I think we're pretty safe to say that this slow growth period will last for at least the next couple of years, and we're also going to see the low oil prices, which will really keep a lid on the ability for areas like Alberta to rebound substantially.